Welcome to Simple Investing Secrets. In today's video, we're going to review 10 seriously undervalued large cap stocks you should consider adding to your investment portfolio. So before we start, please like this video and subscribe to our channel for weekly updates. Let's get started. Undervalued large cap stocks present a particularly good opportunity right now, with all three major indices in the US continuing to trend lower to start the new year. The latest data out of the US showed that inflation rose 7.1% in November from a year ago, which is still well above the Fed's 2% target. This raises the likelihood that the central bank will continue raising its benchmark interest rate in the coming months, albeit at a slower pace than in previous months. As rates continue inching higher and inflation slowly decelerates, stocks are likely to remain volatile. But the retreat of the markets seen in 2022, the worst year for equities since the 2008 financial crisis, has left many large cap stocks deeply undervalued. This presents an opportunity for investors who can tolerate the near-term ups and downs of the market and keep their eyes fixed on the long term. Here are 10 seriously undervalued large cap stocks to buy now. Number 10. Intel Corporation, ticker INTC. Year-to-date return as of December 30, 2022, minus 50.74%. Intel Corporation is a global technology company that designs, develops, and manufactures a range of technology products, including microprocessors, data centers, and other computing and communication components. Intel Corporation's microprocessors are used in a wide range of devices, including personal computers, servers, smartphones, tablets, and Internet of Things devices. On October 28, 2022, Gai Chan, an analyst at Summit Insights, upgraded his rating on Intel Corporation to buy from hold. The analyst anticipates an improvement in the company's gross margin performance through 2023, and his analysis of the market indicates that market share erosion in the company's memory protection unit sector has eased. Number 9. Intuit Incorporated, ticker INTU. Year-to-date return as of December 30, 2022, minus 38.10%. Founded in 1983, Intuit Incorporated is a global financial software company that provides a range of products and services designed to help individuals, small businesses, and accountants manage their finances. Intuit is known for its flagship product, QuickBooks, which is a financial management software for small businesses. The company also offers a range of other products and services, including personal finance software, tax preparation software, and cloud-based accounting software. On November 30, 2022, Scott Schneeberger, an analyst at Oppenheimer, reduced his price target on Intuit to $476 from $516 while keeping an outperform rating on the company's stock. According to the analyst, the company's first quarter results were better than the guidance, although the total growth revenue outlook for 2023 was reduced to 12% from 16% year over year. Number 8. Tesla Incorporated, ticker TSLA. Year-to-date return as of December 30, 2022, minus 69.54%. Founded in 2003, Tesla Incorporated is an American electric vehicle and clean energy company that designs, develops, and manufactures electric vehicles, renewable energy products, and energy storage systems. Tesla Incorporated is known for its electric vehicles, which include luxury sedans, SUVs, and pickup trucks. On December 13, 2022, Mark Delaney, an analyst at Goldman Sachs, reduced his price target on Tesla Incorporated to $235 while keeping a buy rating on the company's stock. The analyst is reducing his fiscal year 2023 EPS projection to $4.50 from $4.90 and fiscal year 2024 EPS projection to $5.60 from $6. According to Insider Monkey's database, 88 hedge funds held shares of the company at the end of the third quarter of 2022. ARK Investment Management was the most bullish fund on the company's stock at the end of Q3 2022. Number 7. Amazon, ticker AMZN. Amazon stock is now trading under $85 a share, its most affordable level in more than 5 years. Following Amazon's disappointing third quarter earnings and lowered guidance, AMZN stock is down 50% in the last 12 months. Even a 20-for-1 stock split undertaken at the beginning of June hasn't helped the share price. Having given up most of the gains it achieved during the pandemic when consumers were forced to shop online, Amazon stock seems to have been abandoned by consumers. Yet analysts say that is a mistake, and the company is poised for a rebound. For its part, Amazon is doing what it can to try to raise its share price, as the company earlier this year announced a $10 billion stock buyback program. Amazon also completed its second Prime Sales event of the year in mid-October, which should give its fourth quarter earnings a boost. The company has also cut staff and taken other steps to save money as it tries to adjust to the current economic situation. While Amazon's price-earnings ratio remains a hefty 75 times, it is not that high when one considers the company's nearly $1 trillion market capitalization or that it generates more than $100 billion of revenue each quarter. Take advantage of the share's weakness and buy the dip in AMZN stock. Number 6. Nvidia, ticker, NVDA. Few large-cap technology stocks have been beaten down as much as semiconductor company Nvidia. NVDA stock has tumbled 50% in the last year to $143. In November 2021, the company's shares were trading above $300, and that was after a 4-for-1 stock split. The share price has been hurt by mounting fears that the demand for Nvidia's chips and semiconductors will slow along with the global economy. To be sure, the company's earnings for the third quarter were a disaster with revenue down 17% year over year. The Q3 print didn't help the share price at all. Nvidia has also lowered its forward guidance multiple times this year. It most recently said that it expects about $6 billion in sales in Q4, lower than the average estimate of $6.09 billion among analysts who cover the company. Nvidia CEO Jensen Huang has stressed that the company is grappling with a challenging macro environment. Still, Nvidia, whose chips are used in everything from supercomputers to artificial intelligence applications, remains a solid long-term buy. Its PE ratio is high at 61 times, but that has come down over the last year with the share price. And unlike many tech stocks, Nvidia pays a dividend that yields 0.11%. It's not the most generous dividend, but it helps make NVDA one of the more reliable undervalued large-cap stocks to buy. Number 5. Nike, ticker, NKE. Over the past year, the stock of the largest company in the world that makes and sells athletic shoes and clothes has taken a beating. The stock of Oregon-based Nike has plunged 27% and now trades at $122 per share. The decline, while no doubt troubling to shareholders, makes Nike stock a screaming buy. A year ago, Nike's stock was trading at $167 per share. Its big decline has been due largely to the same issues that are vexing companies all over the world: supply chain problems, excess inventories, COVID-19 lockdowns in China, and slowing consumer spending. Just before Christmas, Nike reported earnings for its fiscal second quarter that were better than what Wall Street analysts expected on average. This made its stock go up by more than 10% in a single trading session. The shoe company said that its quarterly earnings per share were 85 cents, which was more than the average estimate of 64 cents. Its revenue came in at $13.32 billion, compared to the $12.57 billion that had been expected. The price-earnings ratio for Nike is 34, which is a little high, but it makes sense because the company is the market leader. And Nike stock pays a quarterly dividend that yields 1.1%. Grab this stock while it remains on sale. Number 4. Apple, ticker, AAPL. Apple's stock just keeps getting more affordable and attractive. Its share price fell 15% in December alone, bringing its 2022 decline to 30%. The consumer electronics giant stock is now trading right around $125. Analysts' median price target on Apple stock is currently $175 a share, which is nearly 40% higher than its current level. The share's PE ratio of 20 times is the lowest it has been in years, and the stock pays a dividend that yields 0.73%. With Apple, investors also get a company that buys back more of its own stock than any other publicly traded concern. The most recent news about the company was that its board of directors had approved a $90 billion program to buy back shares. Apple is also becoming more diverse, branching out into new areas such as streaming and buy now pay later. Further, with its iPhones and Mac computers, Apple remains the world's leading consumer electronics company. As with many companies, Apple is dealing with issues that include supply chain constraints, wage inflation, and slowing consumer spending in the face of rising interest rates. Its iPhone production has also been hurt by COVID-19 lockdowns in China. Apple stock took it on the chin after the company announced that it was scaling back production of its new iPhone 14 due to issues in China and weaker consumer demand than forecast. The most recent earnings report from the company was mixed, but it still beat the average expectations of analysts. Apple's lower share price should make the stock more appealing to value investors. Number 3. Costco, ticker, COST. The shares of big box grocery retailer Costco are down 19% over the past 12 months. Costco's 52-week low is $406, well below its current level of $452. The store has been able to get back on its feet by showing that its sales are still strong even though inflation is high and interest rates are going up. The company's November sales figures were mixed. Costco said its net sales for the period came in at $19.17 billion, up 5.7% year over year. However, the firm's e-commerce sales fell 10.1% during the period. Costco stock declined 3% on the data. But Costco has kept its customers' loyalty by saying that it won't raise membership fees this year. Instead, it will keep the regular annual membership fee at $60 and the executive membership fee at $120. The stock's PE ratio of 35 times looks high at first glance, but investors need to keep in mind that Costco is on track to surpass $200 billion in sales for 2022, making it one of the more impressive undervalued large-cap stocks. The company's stock pays a dividend that yields 0.79%, but Costco has a history of paying out special one-time dividends as well. Number 2. Microsoft, ticker, MSFT. Seattle-based Microsoft is a seriously undervalued technology stock. Founded by Bill Gates and Paul Allen in 1975 and publicly traded since March 1986, Microsoft today is a well-diversified and battle-tested technology company that is involved in everything from computer software and video games to online search and cloud computing. The company is hugely profitable and generates positive cash flow. And its stock has been a consistent winner for shareholders over the years. While MSFT stock is down 30% in the last year, it is up 160% over the past 5 years and has gained more than 500% over the last decade. Today, Microsoft has a market capitalization of $1.67 trillion, a reasonable price-earnings ratio of 24, and is one of the few mega-cap tech stocks that actually pay shareholders a quarterly dividend. Its payout currently yields 1.13%. Number 1. American Express, ticker, AXP. The shares of credit card giant American Express are fresh off a 52-week low and currently trading right around $145. With AXP stock down 13% in the last year, AXP stock is at its most affordable level since the pandemic struck in March 2020. The stock's price-earnings ratio of 15 times is right around the average of companies listed in the S&P 500 index. It pays a 1.4% quarterly dividend. With people all over the world traveling and vacationing again, there's every reason to be bullish on AXP stock and the company's future earnings. But don't take our word for it. Consider that American Express is one of legendary investor Warren Buffett's favorite stocks. The Oracle of Omaha has held his current position in AXP stock for more than 30 years and never sold a single share. In addition to traditional credit card loans, American Express also runs a payment system that helps consumers and businesses do business with each other. Revenue from those transactions is today's biggest source of revenue for the company. This concludes our list of the 10 seriously undervalued large-cap stocks to buy now. As always, it is essential to do your due diligence before committing your hard-earned cash to buying stocks or investing in the market. Remember to like this video and subscribe to our channel for weekly updates on the best stocks to buy and cutting-edge investment strategies for building wealth. Thanks for watching, and best of luck with your investments.